Right now, as you listen to this, a process is underway that will destroy exactly half the purchasing power of every dollar you currently hold. Not over a lifetime, not over a generation, over 14 years. This is not a forecast. This is not speculation. This is the mathematical certainty produced by a 5% annual inflation rate compounded over 14 consecutive years. And here is what makes this a matter of forensic interest rather than mere economics. The institutions responsible for protecting your purchasing power are the same institutions engineering its destruction. The Federal Reserve, the central bank of the United States, has an explicit policy target of 2% annual inflation. They state this openly. It appears in their mandate, in their press conferences, in their published projections. 2% is presented as stability. 2% is described as healthy. But 2% compounded over 35 years eliminates half your purchasing power just as surely as 5% does over 14. The only difference is speed. The destination is identical. Your money is being incinerated in slow motion, and the entity holding the match is the one you were told would protect you from fire. What follows is not political commentary. It is an audit, a systematic examination of how inflation actually functions, who benefits from it, who is harmed by it, and why the official narrative surrounding price stability bears so little resemblance to the lived experience of anyone who has purchased groceries, paid rent, or visited a hospital in the past decade. The divergence between official inflation statistics and observable reality was first documented with academic rigor in the late 1990s. In 1996, a commission chaired by economist Michael Boskin, appointed by the United States Senate, concluded that the Consumer Price Index, the primary measure of inflation used by the government, was overstating inflation by approximately 1.1 percentage points per year. The Boskin Commission's recommendations led to a series of methodological changes in how the Bureau of Labor Statistics calculates the Consumer Price Index. These changes included the introduction of hedonic quality adjustments, geometric weighting, and substitution-based calculations. Each modification, viewed independently, had technical justification. Viewed collectively, they produced a consistent directional effect. Each change lowered the reported rate of inflation. The consequences were immediate and far-reaching. Social Security payments are indexed to the Consumer Price Index. A lower reported inflation rate means smaller annual increases for retirees. Tax brackets are indexed to inflation. Lower reported inflation means taxpayers are pushed into higher brackets more quickly as their nominal wages rise. Treasury inflation-protected securities, bonds designed to shield investors from inflation, pay returns based on the Consumer Price Index. Lower reported inflation means lower payouts. The Boskin Commission's adjustments did not merely change a statistical methodology. They transferred billions of dollars annually from individuals to the federal government by altering the measurement of the very phenomenon those individuals needed protection from. This transfer continues every year. It has never been reversed, and it is rarely discussed outside of specialist academic literature. The historical parallel that best illuminates the current situation is not the 2008 financial crisis, it is the 1970s. Between 1971, when President Nixon ended the convertibility of the dollar to gold, and 1982, the United States experienced an inflationary episode that reduced the purchasing power of the dollar by approximately 60%. The official Consumer Price Index peaked at an annual rate of 14.8% in March of 1980. The Federal Reserve, under Chairman Paul Volcker, raised the federal funds rate to a peak of 20%, an act of monetary brutality that triggered 2 recessions but ultimately broke the inflationary cycle. What is rarely discussed is the political and institutional aftermath. The experience of the 1970s traumatized the Federal Reserve to such a degree that it fundamentally altered its operational philosophy. Inflation was not merely to be controlled, it was to be managed, kept positive, kept persistent, but kept below the threshold of public awareness. The 2% target that emerged over the following decades was not chosen because 2% is economically optimal. It was chosen because 2% is psychologically invisible. It is the rate at which your money loses value too slowly for you to notice in any given month, but fast enough to achieve significant purchasing power destruction over a working lifetime. To understand why this matters, consider how currency is supposed to function in a stable monetary system. Money serves 3 purposes. It is a medium of exchange. You use it to buy things. It is a unit of account. You use it to measure the value of things. And it is a store of value. You use it to preserve purchasing power over time. The first 2 functions work regardless of inflation. Even in hyperinflationary environments, money can still be exchanged and used to denominate prices, even if those prices change hourly. The third function, the store of value, is the one that inflation specifically destroys. Think of a dollar bill as a container. When you earn it, you fill that container with a specific quantity of economic value, the labor, skill, or time you exchanged for it. The store of value function means the container should hold its contents. When you open it next year, or in 5 years, or in 20, the same amount of economic value should be inside. Inflation is a hole in the bottom of the container. A 2% hole is small. You barely notice the drip. But the container is always leaking. After 10 years of 2% inflation, your dollar holds about 82 cents of its original value. After 20 years, about 67 cents. After 35 years, about 50 cents. The container is half empty. Not because you spent the money, not because you made a bad investment, simply because you held the money in the form you received it. Now examine the anomalies, the specific points where the official narrative of managed, benign inflation diverges from measurable reality. The first anomaly is the gap between official inflation and experienced inflation. The Bureau of Labor Statistics reported average annual inflation of approximately 2.5% between 2010 and 2020. During that same period, the median rent in the United States increased by approximately 45%, according to Census Bureau data. Health insurance premiums rose by over 55%, according to the Kaiser Family Foundation. Tuition at 4-year public universities increased by approximately 30%, according to the College Board. Childcare costs rose by roughly 40%. These are not peripheral expenditures. They are the core financial obligations of working-age adults. Yet housing is weighted at approximately 36% in the Consumer Price Index, and a significant portion of that weight uses a construct called owner's equivalent rent, which does not measure what homeowners actually pay. It measures what the Bureau of Labor Statistics estimates they would pay if they were renting their own home from themselves. This is not an observable market price. It is a modeled estimate, and it consistently runs below actual rental market data. The second anomaly involves the treatment of asset prices. The Consumer Price Index measures consumer goods and services. It does not measure the cost of assets, stocks, bonds, real estate purchased as investment, or commodities held as stores of value. Between 2010 and 2024, the Standard & Poor's 500 index rose from approximately 1,100 points to over 5,300 points, a gain exceeding 380%. United States housing prices, as measured by the Case-Shiller National Index, approximately doubled. Gold rose from roughly $1,200 per ounce to over $2,300 per ounce. This asset inflation was driven directly by Federal Reserve policy, specifically the creation of approximately $8 trillion through quantitative easing programs between 2008 and 2022. The money did not vanish. It entered the financial system and inflated asset prices. But because asset prices are excluded from the Consumer Price Index, this inflation was invisible in official statistics. The result is a two-tier economy, one in which the cost of things you need is rising faster than reported, while the cost of things you need to build wealth is rising faster still. Official statistics capture neither phenomenon accurately. The third anomaly concerns the velocity of recent price increases. Between January of 2020 and December of 2023, a span of less than 4 years, cumulative inflation as measured by the Consumer Price Index exceeded 20%. In practical terms, an item that cost $100 at the start of 2020 cost approximately $120 by the end of 2023. The Federal Reserve's response, raising interest rates from near zero to over 5%, is presented as decisive action against inflation. But the rate increases did not reverse the price increases. They merely slowed the rate of further increase. Prices stabilized at their elevated level. No central bank policy in modern history has ever returned prices to their pre-inflationary baseline. The purchasing power destroyed during the 2020 through 2023 period is permanently gone. Every dollar held in cash, in savings accounts, in fixed income instruments yielding below the inflation rate during that period lost approximately 1/5 of its value. The Federal Reserve describes this as returning to target. A more precise description is that the theft has been completed, and the rate of ongoing theft has been normalized. The fourth anomaly is the relationship between money supply expansion and consumer prices. The M2 money supply, the broadest commonly tracked measure of money in the economy, increased from approximately $15.4 trillion in January of 2020 to approximately $21.7 trillion by March of 2022. This represents an increase of approximately 41% in just over 2 years. The monetarist equation, the quantity theory of money, holds that if the money supply increases and the velocity of money remains constant, prices must rise proportionally. The 20% cumulative inflation observed between 2020 and 2023 accounts for roughly half the money supply increase. The remainder has been absorbed into asset prices, bank reserves held at the Federal Reserve, and reduced monetary velocity as certain economic sectors contracted. But the arithmetic remains unresolved. Over $6 trillion of new money was created. Consumer prices have adjusted to absorb some of it. Asset prices have absorbed more. The system is still digesting the remainder. This is not a stable equilibrium. It is a process in motion. The fifth anomaly is the systematic disadvantaging of savers relative to borrowers. The Federal Reserve maintained the federal funds rate below the rate of inflation for the majority of the period between 2008 and 2023. This policy is called financial repression, a term coined by economists Edward Shaw and Ronald McKinnon in 1973. When interest rates are below inflation, borrowers benefit because they repay loans with money that is worth less than the money they borrowed. Savers are penalized because their deposits earn returns that fail to compensate for the loss of purchasing power. The largest borrower in the United States economy is the United States government. In fiscal year 2024, net interest payments on federal debt exceeded $880 billion. Each percentage point of interest above inflation costs the Treasury hundreds of billions annually. There exists a direct, quantifiable incentive for the government to maintain interest rates below the inflation rate. This is not a conspiracy theory. It is arithmetic applied to the balance sheet of the world's largest debtor. The sixth anomaly is the revision of inflation expectations as a policy tool. In 2020, the Federal Reserve formally adopted a framework called Flexible Average Inflation Targeting. Under this framework, the Federal Reserve explicitly committed to allowing inflation to run above 2% for extended periods to compensate for prior periods of below-target inflation. In plain language, the Federal Reserve announced that it would intentionally permit your money to lose value faster than its own stated target, and it described this as responsible policy. The framework was adopted without legislative authorization. It was not voted on by any elected body. It was an internal policy decision by an independent institution that controls the value of the currency used by 330 million Americans and serves as the reserve currency for the majority of global trade. Two interpretive frameworks can explain these patterns. The first is institutional inertia. Central banks are staffed by individuals trained in models that treat moderate inflation as economically beneficial. The methodological changes to the Consumer Price Index reflect genuine attempts to improve accuracy, not to deceive. The money supply expansion of 2020 was an emergency response to an unprecedented pandemic. Asset inflation is an unintended side effect, not a deliberate strategy. Financial repression is a consequence of competing policy objectives, not a wealth transfer mechanism. Under this interpretation, no one is stealing anything. The system is simply complex, imperfect, and struggling to balance conflicting mandates in an increasingly complicated global economy. The second interpretation follows the money. Every methodological change to the Consumer Price Index since 1996 has lowered the reported rate. Every adjustment has reduced government obligations indexed to inflation and increased the real tax burden on wage earners. Every period of financial repression has transferred wealth from savers to borrowers, and the largest borrower is the government itself. Every round of quantitative easing has inflated asset prices, benefiting the approximately 10% of the population that owns 89% of all stocks. The pattern is consistent. The direction is uniform. The beneficiaries are identifiable, and the mechanism is hidden inside technical language that requires specialist knowledge to decode. The evidence needed to distinguish between these interpretations is publicly available, but scattered. The Bureau of Labor Statistics publishes its complete methodology online. Every hedonic adjustment, every substitution assumption, every weighting decision. The Federal Reserve publishes transcripts of its Federal Open Market Committee meetings with a 5-year delay. The Treasury Department publishes auction data showing who buys government debt and at what price. The financial accounts of the United States, published quarterly by the Federal Reserve, show the distribution of financial assets by wealth percentile. Cross-referencing these datasets reveals whether the outcomes align with the stated intentions, or whether the stated intentions serve as cover for the outcomes. The international dimension amplifies the significance. The European Central Bank has pursued a nearly identical policy framework, 2% inflation targeting with periods of deliberate overshoot. The Bank of Japan has maintained near-zero rates for over 2 decades, while government debt has exceeded 260% of gross domestic product. The Bank of England raised rates aggressively in 2022 and 23, but has not unwound the quantitative easing that expanded its balance sheet by hundreds of billions of pounds. The People's Bank of China does not publish transparent inflation data, but independent estimates consistently exceed official figures. The International Monetary Fund publishes annual assessments of global inflation that acknowledge measurement challenges, but stop short of questioning whether the systematic direction of those measurement errors serves institutional interests. Every major central bank on Earth is simultaneously pursuing a policy that guarantees the erosion of its citizens' purchasing power, while describing that erosion as stability. The coordination is not necessarily conspiratorial. It may simply reflect a shared institutional culture that has internalized certain assumptions about the necessity of positive inflation. But the effect on the average person holding cash savings is identical regardless of whether the cause is conspiracy or consensus. The question this analysis leaves open is not whether inflation destroys purchasing power. That is settled arithmetic. The question is whether the institutions tasked with managing inflation are optimizing for your interests or for the interests of the entities that benefit most directly from the controlled destruction of your currency's value. The Federal Reserve employs over 400 PhD economists. The Bureau of Labor Statistics maintains one of the most sophisticated statistical operations on the planet. The Treasury Department manages the largest debt portfolio in human history. These institutions possess the analytical capacity to model every consequence described in this analysis. They understand the distributional effects of financial repression. They understand the wealth transfer embedded in asset inflation. They understand that methodological adjustments to the Consumer Price Index reduce government obligations by billions annually. The question is not whether they know. The question is whether a system designed to maintain price stability can be trusted when the institution defining stability is also the institution that benefits most from defining it loosely, and when the only people who would notice the difference are the ones who never learned how to read the footnotes.